Hello everyone, in this video we're going through the topic of compensated absences. So again, this is another type of current liability, okay? A compensated absence, what is it? It's when an employee is paid when away from work for a vacation or for illness or for a holiday, okay? So basically when you're away from work, but you're still getting paid, it's like paid time off, right? We've all heard of paid time off for a vacation or illness or a holiday, okay? So most companies give employees paid time off for vacation or sick days, maybe even holidays as well, okay? And so we have these two topics of vested rights and accumulated rights we have to go over very quickly. The concept of vested rights. So when an employer has an obligation to pay an employee for days off regardless of future service by the employee, meaning that if an employee has 5 days of vacation vested and quits the next day, he is legally entitled to 5 days of extra pay for those vacation days that vested. Okay, it just means that once they vest, the employer has to pay it out. They have no choice. They must pay out these for these vacation days that are actually vested. Okay, so it doesn't matter if the employee keeps working or does anything more for the employer. Okay, the employer has to pay it out. Accumulated rights are a little different. This is when days off carry over to the next period. So if a company allows its employees to use days off earned in the current period during the current year during the next year, okay, they're said to accumulate. Okay, so if you earn them this period, but you're allowed to basically carry them over to the next period, okay, that would be said that they are accumulating. Okay, you're allowed to use them days earned in the current year. You can use them during the next year. Okay, that would be an accumulated right. So basically, companies must accrue a liability for compensated absences in the year the employees earn the paid time off, and the paid time off either vests or accumulates. Okay, so basically, once the employees earn the paid time off and the paid time off either vests or accumulates, in that case, the company must accrue a liability for that, because at that point, they're basically going to be required to pay out a certain amount of money to these employees. Okay, so when making this accrual, companies generally use the employee's pay rate at the time of the accrual, not a future pay rate. We'll see what this means in a minute. But then there's this follow-up point that says, when the company pays employees for paid time off, the company will generally record more expense due to a discrepancy between the rate the liability was accrued at and the employee's current pay rate. Basically what this is trying to say, we will see this in a problem, it will make a lot more sense then, but basically what this is trying to say is that, okay, when you accrue the liability, you're generally going to accrue it at the rate that the employee is currently being paid as of the end of the year, okay? But once the employee actually gets paid, a lot of times by that point, they'll actually have a pay raise, okay? So you have to pay out the money at the higher pay rate, okay? Which means that the liability was accrued at the lower pay rate, but the money is going out, the cash is going out at the higher pay rate, which means you have to record more expense because there's a discrepancy between what you accrued it at. I guess the accrual will be lower, so what you accrued it at versus what you're actually paying it out at, okay? And we will see that in this problem here. Okay, so we just have a quick example of a compensated absence problem. So we have XYZ company has 20 employees who work 8-hour days and are paid hourly. During each year, each employee earns 10 paid vacation days. The vacation days can be used in the year after they are earned. The following information is available concerning the employees' vacation days. Then we're told the actual hourly rate for 2016, 2017, and then we're also told the vacation days used by each employee. 0 in 2016, 6 in 2017. Then it says, prepare all the relevant journal entries for XYZ company for 2016, 2017. Okay, so when it says prepare all relevant journal entries, that's on us to know what journal entries we need to record, right? The problem isn't telling us, oh, record journal entries at this date or whatever, or prepare the entry to do this and this. We need to know all the necessary entries to make to get the full points for this problem, okay? So the first entry we're gonna make is the 2016 accrual, okay? And that's because that's the first thing that happens, right? In 2016, these employees earn 10 vacation days, okay? They work 8 hours, there's 20 employees, and they make $15, okay? So they earn 10 vacation days. They can't use them until 2017, and so they don't use any in 2016, so we don't have to make an entry for using them. We have to make an entry for accruing them. So the compensated absence accrual, again, you take the number of employees, you multiply it by the number of hours that they work a day, okay, then you multiply by the number of vacation days, and you multiply by the rate per hour. That's going to give you the accrual, of $24,000. So we say December 31, 2016, salaries and wages expense, salaries and wages payable, debited and credited for $24,000. Okay? Then we have the use of the employee vacation days. Okay, that would be in the next year in 2017. We use 6 days. Okay, now again, remember, these employees, their rate does change. Okay, it goes up between 2015 and 2017. 2016 and 2017. Remember, we accrued this at the $15 an hour rate, but we have to pay out the cash at the $20 an hour rate, which means we're going to have a discrepancy between the amount of the payable that we're going to remove from the books and the amount of cash we're going to pay out, which we're going to see right now. That discrepancy is going to be recorded as extra salaries and wages expense. So let's see how that works. The cash paid out is going to be 20 employees times 8-hour days times 6 vacation days used times $20 an hour. $19,200 we're going to pay out in cash. Now the payable that is used up, right, the payable that is actually used up from last year, right, would be 20 employees, 8-hour days, 6 vacation days, right? It's only 6 because they're only using 6, times the $15 an hour rate that we accrued at, right? We accrued it at $15 an hour. We have to take the payable off the books at $15 an hour. That gives us $14,400 of payable, okay? So the difference between these two amounts is additional salaries and wages expense, right? Because we're still paying them cash, so it's still expense to us. We're going to record this additional expense, and 2017 we actually pay out the cash. The additional expense is $19,002 minus $14,400, which gives us $4,800. Okay, the $4,800 is the 20 employees times 8 times 6 vacation days times the $5 difference in the rates. Okay, you can also solve for it in that way. Okay. So then we have the compensated absence accrual, okay, as well that we have to solve for. But let's do the journal entry for this one first, and then let's do that one after, okay? So the salaries and wages payable is reduced by $14,400. The salaries and wages expense is the difference between that and the cash, which was $19,200. It's $4,800, okay? We solve for all those numbers up there, and we make the journal entry there. Again, remember, the reason we have this extra salaries and wages expense is because we're paying out the cash at the $20 an hour rate, whereas the payable was accrued at the $15 an hour rate. Now we have to make the compensated absence accrual for the days earned in 2017. Again, this is at the $20 an hour rate. So now we have 20 employees, 8-hour days, 10 vacation days, $20 an hour gives us $32,000. We make our accrual at December 31 of 2017. Salaries and wages expense, $32,000 debit. Credit to salaries and wages payable for $32,000. Okay, so that's basically the end of this video. It's mainly just realizing that, okay, you have to make this accrual, then you have to make a journal entry when they're paid out, and there's a discrepancy between, assuming that the rate changes, and a lot of times it does, and it generally goes up, there's going to be a discrepancy between the payable that comes off and the cash goes out. The discrepancy goes to salaries and wages expense. Then we have one more accrual generally to make at the end of the second year, okay? So that's how these problems work, and that's the end of this video. So I hope that was helpful.